But for those of you that are joining us, we are joined today by Yoni and Nick, who are the founding partners of South Col. Nick is the CEO, and Yoni, your title is just mysterious founding partner.
Mysterious founding partner. That's it.
And Yoni and I have kind of we've been internet friends, haven't we, for a number of years?
We're about to be real friends.
Yeah, we're going to meet each other
on Thursday.
Looking forward to it. And yeah, Yoni's also the CEO of two companies, Escala and Multiply Me. And prior to this gig, Nick was CFO of Sellers Fire, which is a funding platform for e-commerce businesses. Today, they're going to be speaking to us about South Col, which is a profit accelerator. And I suppose, Nick, if you'd like to give a quick introduction to South Col.
Yeah, absolutely. South Col is a joint venture between three companies: Escala, which is Yoni's company, which is a process management consultancy, and Multiply Me, which is a way to get really talented, very highly skilled workers outsourced from the Philippines to do, sort of think Ernst & Young or Anderson Consulting type level of quality people from there. Then we also have GW Partners, which is Chris Schifferling and Jason Somerville, and they're also co-founders. So those three companies, Escala, GW Partners, and Sellers Fire, came together to create South Col. And to start with, South Col is the last base camp before you summit Mount Everest. And so we intentionally chose that as our name because we work with people who have built phenomenal companies, and they're already up the mountain. I mean, they're doing anywhere from 4 million a year to 50 million a year. And what we did is we realized that we raised a $50 million fund, and the fund that we look to do is to put in capital, expertise, and working with people hand in glove with successful entrepreneurs to grow them who are looking to sell in 18 to 24 months. So when we come and look at a company, we say, what can we all do? And if you look at the three companies that are the joint venture, you've got capital, you've got investment banking, Global Wired, and you've got Escala, which is process management. So we hit you on all three legs of the things that are going to be important for a company to grow. So when you're looking to sort of exit, what can we bring to the table? We bring experience at almost every facet of what you're doing, because people who are looking to exit, it is a process, and we map out. We literally will come in. We have a 90-day plan where we come in and we do the first steps of things. Then we build out a plan that's for, the next slide will show, says, look, you need to look for 12 to 18 months to build what we sort of identify as the lead areas. And then Yoni, we can go to the next slide. So first thing, my background, I was the chief financial officer of Sellers Fire. And Sellers Fire provides, 300 million of loans to e-commerce companies, specifically only e-commerce companies. And so in that regard, I sort of look a lot at what's going on in the economics, in the economy, and how the US, and this is very focused on the US because that's going to drive a lot of where e-commerce sales are going to go, even though obviously e-commerce sellers can be all over the globe and always are. There's sort of in the next 12 to 18 months, if you think about this, there's 4 possible sort of areas that US economy ends in. And what you look at is what's going to happen with inflation and what's going to happen with real growth. Stagflation, okay, that's right now, the probability of that happening is going down because that's a really bad place. That's where you have economic stagnation and you have inflation, which is not the area that you want to be. But because of the fact that the supply chain is coming in and becoming more normal, consumer price index is moderating, and the employment market is tight, the Fed is being very harsh, very hawkish, which means they're very focused on making sure we don't end there. So I would say that that's not highly likely that we end up there. Then if you go on to the next, reflation. Now that's actually the probability of that happening is going up. This is because they still think that if we look forward, the US Fed, which is what controls interest rates, because they say what banks lend to each other. And they have in the last year raised those rates as dramatically as they've ever done before. And so what that's done is you see everything's going up. So from credit card interest rates, mortgage rates, everything gets affected through the economy. And now people are saying, well, what they see now is by the end of the year, they're going to start cutting those rates. So that would then increase the amount of liquidity in the market, which means people lending out everything from mortgages to credit card debt to store credit card accounts to everything that goes in there. And we now have a Federal Reserve that's focused and understands the political implications to what they're going. And if you go to the next, which is also the probability that's increasing, is the recession, which if you talk to people, they're very concerned that with all the rates that have gone up, it's decreased the amount of economic activity because people don't want to build new office buildings, don't want to buy a new crane for their business, because if they take out debt to do that, it's more expensive now. So people are stopping projects. And then when you stop projects, that means your earnings, revenue, and everything is going to go down. And that's what causes a recession. And so they're balancing to try to stay out of stagflation. The Fed is pushing towards recession, feeling that in a recession, that's almost a better outcome than stagflation, even though it's not a desirable outcome. And what I can tell you is that in 25 years in the credit markets, this is as tight as it's been, even during the Great Recession of 2008 and the downturn of 99, all of which I was on Wall Street and sort of saw it. And people right now are holding their money. They're saying, we have money because we've done well, but they're not putting it out. And so people have really started closing up their investment. Now, soft landing, this is the most desirable. This means, lower inflation, but it's not going away completely. You're going to still see economic growth, and labor, everyone has a job that wants a job, so they're able to sort of have and work and pay for their mortgage, their diapers, their families, and everything else. And while this probability is decreasing, it isn't zero. And this is where we hope that as a very dominant sort of economic power, we hope the US market ends in this soft landing, or one of the others, which is sort of a soft recession to a quieter landing, right? Sort of like shifting through there. Because really what we would hope for, what I would hope for, is that people normalize, that the economy stabilizes. Because right now, the instability is that people don't know where it's going. People are very scared of stagflation. People are very, very scared of a large recession. So right now they're sort of saying, I'm going to stay on the sidelines to see what happens. So hopefully that people get some firmness of understanding that we're okay and we can go forward. And now, that's a lot. What the hell does this mean for e-commerce? How does this impact you who sell, on e-commerce? Well, here's how it affects you. It comes through, and what you can see is that people aren't lending money to e-commerce people and to e-commerce companies, where we would love to see more money being given out to companies that are producing products and selling them and helping the economy grow. So while we see it tightening, I would love to see this sort of come. Then if you go to this, is what you see is there's also margin pressure. Because when interest rates go up, that means you're paying more. If you get some debt, you're paying more in interest. And so that means you have to be more profitable. And so really what I would tell everybody who's out there doing e-commerce is you need to know exactly when you sell your widget online, you sell it for $15. If the fully landed cost of that is $11, that's $4 of profit for you. And you need to know that, because that's what you need to be focusing on. Is you need to understand all the advertising you put into it, all the labor you put into it, all the shipping, all of the costs. to get that widget in your customer's hands, you want to make sure that you have margin and positive margin. Here's a little interesting graph that I think sort of speaks very much directly to e-commerce companies, which is Amazon seller multiples. So this means that profit that you make on that widget, that $4 in my example, the $15, $4 there, that $4 times as many widgets as you sell, that's your SDE. That's your, seller's discretionary earnings or EBITDA. And what you see is people pay a multiple of that. So they take what you did in the trailing 12 months and they multiply it by a number. And what you can see with multiples, when you're a seller, you want those multiples to be high. You want those multiples to go through the roof because every time they're paying you more multiples, you're getting more money. But what you see at the graph on the left here are on the left side of this slide is you can see that while they went really up through COVID and you saw them go, approaching 4 to 8, we've seen them go all the way back down to 2 to 3.5 times. So that means if you're making $1 million of SDE, your company might be sold today for $3 million. If you're in the middle of that 2 to 3.5 times. Then the other thing that you see is fewer companies are selling. Now, why is that happening? One, less money's out there to buy companies right now. Two, people who have successful companies aren't looking to sell. They're running their companies, which we'll get back to like where South Col sort of fits in this. But anybody that's running a good e-commerce business, my advice to them would be to run it now. Because selling into this market, you're gonna get hit by what the market is like. You're going to be in that range of sales because that's what a range is. It's top to bottom. Now, if you're really good, you might be at the top end of that. But I would much rather wait a year or two and sell when multiples are back up to where you can get 8 times. So that's
what's also just to note, if you're looking at this graph, is that the data we have here is up until Q3 of 2022. So it's shifted even further into the direction that we all don't want to see it shift as e-commerce business owners and as people who are obviously trying to maximize our outcome.
That's right. And it will get better. And that's the other thing I always say to people, like, just because it's dark now doesn't mean it's not going to be daylight later. And right now for e-commerce companies, it is for sure a very, very tough environment. And it doesn't mean that there aren't great companies. It doesn't mean that great companies can't sell. It just means it's harder. And it means, it's difficult. So if you go down through this funnel, there's 350,000 American sellers that sell over $100,000 a year. 125 of those are over 500, 60,000 are over $1 million. So we've already gone down. Look at that funnel already from, 350 down to 60, just at $1 million. And then for us, where we target customers, e-commerce companies that are selling a minimum of trailing 4 million. And so you can see that in order to be able to have a successful exit, you now need to be pushing 10 million in revenue. That's going to be where you'll get interest and be able to sell. So even if you're at 4 million, it means, you probably are going to have to double it plus, 250. You have to go up 2.5 times. That's going to be where you're going to be able to separate. Because if you want to sell your company, you need to understand that the buyers now, the only end of the market that's sort of selling are people that have generally 2 million or more of SD or EBITDA. And so you can sort of think about like where you are, where you need to grow to be able to get to there. Because if you get to there, that part of the market, there are still strategic buyers. But strategic buyers only buy strategically, which means there has to be a size and a scope that makes it, their desire to buy. And you have to build a roadmap of how you're going to be able to get to it. So I do believe that in the next 12 to 18 months, we're going to get back into what I call pent-up demand. Because people right now aren't buying, but there is interest to buy. There's money to buy. Well, when we fast forward 12 to 18 months, they're going to want to, unleash that capital and put it to use. So there's a limbo tier. So if you get in here, is if you have 750 to 1 million, here's the challenge. You're doing well. It's phenomenal. You already have seen you're in the top 5% of e-commerce companies, which is amazing. And you need to make a decision. Okay, do I want to take that money, invest it back into the company to try to grow it? Or do I want to sell for 2-3x that number? So that would be whatever, $2 million sale, $1.5 million, maybe $2.5 million sale, which that doesn't fully value what you built. If I were thinking about this, that's one limbo where you're making money, but now how are you going to go from there to the next level? Then the second tier is, this is $2 to $3 million in SD. So now you're in that. You're probably doing 10 million in sales. Now, here you're there, but you need to get over the line where, okay, I now want to make this company as attractive. I want to build that multiple. I want to get it 7 times. I want to get 8 times multiple. Well, what do you need to do? What does your company need to do to where a strategic buyer is going to say, that's where I want to put my capital. I want to invest in this e-commerce because they're now ready to go. And so one of the things that we focus a lot on is saying to founders, let's talk about how that exit looks and what they're looking for. You've built a great company, so we don't need to say to anybody, well, hey, this is what you need to do to build a company. We're not here to sort of teach you the ins and outs. You know that. You know your product. You've addressed a market. Because that's one of the other things I didn't even hit on, which is when you're a successful company, you've built a brand where you've addressed a customer's need. And they're looking at you and they're going, your product solves something for them. It either makes them happy or it solves a problem. And you're addressing it. Well, now what we need to do is go, let's look at your company and say what your company could do to a strategic buyer. And that's the phase where we come in. And I believe that this year into next is a great time to do that, because the process of switching that thinking takes time. And I believe it takes, 12 to 18 months, but it can be done. And now's the time to do it, because you've already built this great business and you're growing and you're profitable. And now we want to maximize that exit value. And you want to hit the market in 12 to 18 months when there's unbelievable demand for e-commerce companies and there's capital behind it to buy it and, to purchase the successful companies that use this time to grow. And then
So,
if you go to that.
yeah. So just to share with you guys, like the whole idea of where we're taking you here is really, Nick's really spent time laying down the foundation and giving you guys like really high level insights into, things that are above my pay grade. There's a reason he's the CEO and I'm not of South Col here, but really, understanding what the current state of the market is and where we sit and, what and how we're approaching it. So for the rest of the presentation, we're really going to focus in on if we're in your position. So whether you work with South Col or not, we're here to create value. And the main thing that we want you guys to take away from this is how can you, in what is a challenging market right now, maximize your upside? And I think like one of the distinct differences that's probably in one of these slides that's coming up here is that there's been a lot of talk over the course of the last few years as the aggregators had risen, is like getting prepared for exit and, having a real focus on how do you sell your business and package it up and go through that process. What we're trying to actually articulate here is that, and Nick has been really red hot on it up until this point, is that you need time to actually have a material difference in growing that multiple and impacting that SDE. And it's not going to happen in 90 days and it's not going to happen in 180 days. That's the reality. And so what we're really going to build towards today is just sharing with you guys how we approach it when we're investing in companies, what we're looking for. And I'd say more importantly, what are we actually doing with them to have it make sense for the founder at the end of the day, so that that business grows from $1 million EBITDA at a 2 times multiple to a 2.5 million EBITDA and a 4.5 times multiple, and where that becomes a really meaningful exit in terms of how much money founders can take home and getting them over that limbo tier. So I probably should have done my homework and looked through the presentation again. It's been a minute, but I think all of the doom and gloom.
Yoni, just 2 secs, Wallen. So for anyone who missed it at the beginning, if you have any questions, the Q&A panel is active, so you can type out a question. I know Moazam's been sending a few through. But if anyone else has any, like myself and Nick will probably try and help. Thanks, Yoni.
Not a problem. Yeah, please. The idea here is really just to add value to you guys that are sat here. I think that's the benefit of being live on one of these things as opposed to watching the review. So, you guys have made the effort, so we're happy to start and stop and answer any pointy questions. So like I started sharing, there's a real difference between exit ready and multiple expansion. And so Nick, maybe you want to talk a little bit about this and I can take the next little section.
Perfect. So when acquirers are looking for exit, the first thing you have to have your financials in order. So it is really imperative that you understand every single aspect of your business. And even when you watch Shark Tank, just very pop culture, right? But they always are stressing,
it's known as Dragon's Den in the UK.
And Dragon's Den in the UK, right? That's it, right? That idea, right? But one of the first questions they always ask is what are your financials? And so one of the things that is a lot of companies that even, and this is where, Joe, is the expert here, right? Is you need to know what your COGS are. You need to know what your marketing expenses are. You need to understand that. And that's one of the reasons that having clean financials and knowing those and improving them is so paramount. So I mean, that's a huge one. Then intellectual property. So what do you have? What's competition? Who can compete? What are your barriers to entry? What's your brand? What's your controlling sort of ability to do that? And if you don't have any, you need to understand, do you need it? Because strategic buyers really do like to have some moats that protect them. So if they're going to buy a company, they want to know that they're the only ones that can sell it and do it and be able to do it in the long term. Then another problem that one thing that when you're exit ready, you need to understand every SKU, what each SKU is bringing to your company. And if you have SKUs that aren't performing, why do you have them? And if you have to have them, which sometimes you do, sometimes you have, SKUs that are necessary for your, really, really performing SKUs to be there. But I would really spend some time sort of going, what SKUs work? Then you also need to make sure that you have a development, where is your company going to be? What are you going to be selling in 2 years, 3 years? Do you have a roadmap? Have you thought through what your next products are going to be? Have you thought through sort of where are you going to go with what you sell? And then for your business, what are your plans? What are your projections? And how do you secure and make those projections such that they're actually predictions, right? They're not, sometimes people are like, well, I can put anything. Well, sure, you definitely can. But projections, when they're done really well, somebody looks at them and goes, I see what they're doing. I see they're going to sell, 10,000 of this unit. They're going to sell this unit. They're going to produce, this new product that they're developing. And they've shown that they've developed 3 other products. And so therefore, this one's going to follow the trajectory of those. They're going to improve it by 5 or 10% because they've learned how to enter a new market. They're going to the EU. They're in England now. They're going to the EU, or they're going to the US, or they're going to Australia. And there's really base-driven sort of fundamental knowledge of why all that's true. Because really these 5 things, when you sit down and you talk to investors, they're going to hit you with all of these, either specifically, directly, or during the course of what they do, because this is sort of the baseline of how you look at a business.
So yeah, so to Nick's point here, this is, especially if you speak to anyone who's gone through that exit process, and a lot of people who actually go down that process and don't successfully exit, they know a lot more the next time they go down that process, and they're in a better position to at least give everyone the information that they're looking for. But when we talk about the current state of the market, and we talk about what can you really be doing today to when the market does rebound, or when you get big enough for it not to make a significant material difference in the market, because strategics and private equity buyers are always going to be buying things that fit inside of their mandated portfolio that are going to help grow their business. What we're going to talk to you guys about today is what we think that you should be focusing on 2023 and beyond. And that's either on growing your multiple or growing your seller discretionary earning, or as you get larger, your EBITDA. So firstly, it's actually understanding, the financial engineering of the business and taking a really clean data capture process where we're actually looking to clean things up and build toward that alignment. So, Nick touched on moments ago a little bit about the fact that, what are the SKUs that are performing? Once you start to have that degree of clarity, you can start to either double down and focus on the things that do have the margins in the SKUs, that do have the possibility to grow and to actually be scalable, as you start to hit, those next thresholds. And if you're negotiating the right price breakdowns with your suppliers and your manufacturers and how you're approaching it, those economies of scale really, dive or come into play here. So it's not just about getting clarity here. It's actually about building out that indication. I'd say, Nick, if there's anything that you want to jump in and say while I'm going through this, by all means.
Can I just ask a question that people might be thinking but haven't typed? Do you guys have, so you work obviously with e-commerce businesses, do you have any particular niches or platforms that you don't work with, or are you pretty agnostic to all of them?
I would say that the way in which we're looking at it is that we're going to work with most. Like, we have investments in pure D2C and not Amazon, and pure Amazon and not D2C, a combination of both, different geographies and countries. Like, those things are not particularly, pressing or concerning for us. I would say, like, the things that we would be hesitant to touch would be, businesses that might be resellers, for example, where it's a much harder, the margins are typically slimmer, and that also becomes sort of a non-starter. Like, once you start dipping below those sort of 15% margins, it starts to become a very different conversation for us. And I think it should be something that you as a seller should really be working toward, pushing that up to something, in the 20% range or higher if you can. Even better, the higher the better. But we're pretty agnostic. If you were like really on the small end, if you really sort of just dipping your toes in the water, that would be something that you're probably not ready yet, because for us to invest this amount of time, and we're talking about injecting $1 to $5 million of capital into a business. If you're only doing $50,000 a month, it's almost disproportionate to the impact that it'll have on the business and how you could spend it. I'd say the last thing that would be a hesitation or something that we're less, what's the word I want to use here? Like, we're less bullish about would be like supplements. Would, you'd have to have a really compelling case in a market like that. But Nick, anything else that I've missed that, we're relatively open here?
Yeah, for sure. I mean, it to us, it's product market fit, profitability, and sort of ability to grow. Because, like, I was just answering a question that was asked online, which is, we're agnostic as to, like, Yoni said this exactly, which is like, if you're on Amazon, we would say, well, what could you do D2C? If you're just D2C, well, what could you do on Amazon? If you're in the UK, could you sell in the US? Could you sell in the EU? Could you sell in Australia? Every one of these, if you're on Amazon, could you sell on eBay? And how could you profitably expand? Because each one of these things is, from my point of view, are channels and their growth levers. And if your product works in one market, is there a reason it wouldn't work in another? Now, sometimes there are. Sometimes there are ones that are going to be driven, that need to be proximately, located. Like we worked with a dental company, and they're based in the UK, and like they had to take your imprints, and so there's a lot of like regulations around it. Like, so expanding for them was very, very costly. So then we had to think about, okay, how do you optimize within the UK? Because going through the FDA, to go through and get all this stuff would be pretty laborious. And, there could be a return, but like, that's a different consideration than if you're selling, a juvenile girl craft that is selling in Australia. Well, it probably would also sell in the UK because, juvenile girls are going to have a lot of commonality in what they might, like. And if you have a brand that sells. So for me, when I look at all this, what Yoni said is exactly right, which is we want to expand the areas that you sell in. And we want to help think about what are the easiest and largest channels by which your company can grow. And it's going to be different based on whatever your company is. But there are, off the top of my head, more than a dozen different markets and channels that we would sort of start with and analyze which ones are going to be best specifically for whatever it is that you sell as a.
And lastly, on the softer side of things, the way we're operating, and we haven't gone in, and this isn't, we're happy to answer any questions and show any founder of any business, very happy to talk about their business and the model and what they've built. But I think one of the really important things to share at this point is that it's really about the founder or the business owner's mindset and how they're approaching it. If this is someone who has all of the answers to the cheat sheet, doesn't feel like an investment bank funding and, experts in process improvement sitting with you every single week can add value throughout this process, then it's probably not going to be the right fit. Like we're really looking to invest and partner with businesses and business owners. And so I'd say, like, outside of, some of the, the critical financial markers, we are sitting on the finance slide here. That to us is really important because, we're getting really deep into the weeds and we're going to be working with you for a 2-year stretch. So, while it's not a lifetime, it's a meaningful amount of time. And for those who we'd be working with as well, to walk away with all of these documented processes, understanding how to pull all of these growth levers, being handheld throughout the process, having accountability partners really guiding you through this, and having sort of the level of expertise that's brought into and infused in your business. Like, those are the people that we're looking to work with, I would say, most importantly, assuming that they meet those other criteria. So on that point, we've actually covered a few of these things. Nick was talking about answering the question about, the different marketplaces and how that's a massive growth lever. Another really high value expansion, multiple expansion growth lever is actually building out your product pipeline. So one of the things that I would say was probably challenging when you look at sort of the aggregator model is that you are effectively acquiring a business and you're removing the founder, who is, historically the lifeblood of that business, with the product ideas and all the innovation, often not able to get the time into actually building out, all the brilliant ideas that they have and bringing it to market. So what we would highly recommend, and what we do inside of South Col is freeing up your time to focus on things like this. If you can build the next 5, 10, 15, 20 products inside of your brand to expand it, and forget even looking to bring it to market, if you can even just hand them to the next owner so that they have the next 12 to 18 months, I mean, that's going to be pretty significant when you talk about the multiple expansion. And that's some of the IP and the value. And if you can actually emulate the process on how you're coming up with products, I mean, that takes it to an entirely different level. And, just really important things to consider, that we all know with e-commerce that launching products is, particularly on the Amazon marketplace and most marketplaces for that matter, is how you're generating a lot of your growth and continuing to innovate and grow that revenue and that SDE. But being able to actually package that up and work through it has a material difference on what that multiple looks like. When we talk about legal and IP and compliance, it's not just about checking, as a last stitch effort. And, we don't have Chris and Jason on the line here, but I'm sure they could share some war stories on when someone's looking to bring a business to sale and, they actually didn't have the design patent, or they're actually in breach of IP or some sort of legal and compliance issues. And all of a sudden the deal falls down. So when given more time and finding real defensibility inside of your brand, spend the time to invest in understanding. I mean, firstly, before you even launch, are you breaking any of these guidelines, and am I actually clear to sell? But more importantly, get that trade and design patent, work on the legal and compliance requirements, make sure that competitors aren't easily just going to be able to knock you off with a Chinese knockoff, or worse, China comes after you and there's no way you're competing. So really, really important to have that well built into it, and coming back to actually bringing that to market. Without that stuff, the deal can often not go anywhere. So huge lever that can be pulled there.
And sorry to jump in there again, Yoni, but a bit of a future plug for the webinars that we're doing at the moment. I've not sent out an email of the schedule, but in the coming weeks, we're doing a bunch of different webinars on a variety of topics. And I'm speaking with an IP solicitor in the UK to go over all these sort of topics. So anybody who's interested in who's not already compliant in the UK, join us for that, because it'll be very useful.
Heat that one up beautifully for you guys. Get in, don't miss out. We rehearsed this one. It came off well, I felt. So obviously another key area, and something obviously that's real close to my heart, and I'm going to share with you later on some of the details of how we're actually approaching operational excellence, is I want to just give you sort of the idea, or at a very high level, when a potential acquirer is buying the business, the idea is not to buy the people inside of it, and to have key man risk, to have significant investment every single time someone is onboarded, to know that this founder and the team, whatever that transition period looks like, whether it's 30 days or 2 years, at some point you're going to lose all of that high value intellectual property on how to actually, everything from building products to running the operations. So having all of that very clearly documented can have a tremendous, not just on multiple expansion, but also from the standpoint of opening up the buying pool. So if potential prospective buyers can actually understand and look at all of your SOPs, training videos, documentation, how you've actually created all of your internal content and your company wiki and elements like that, it makes it very, very simple for them to understand what they're acquiring and what the scalability looks like inside of that business. And that's really their intention, is to plug it into something else that they have going on to continue to effectively make back and increase the money that they've invested in paying you for that brand, for that asset. Then we have marketing optimization. So when we talk about marketing optimization, just to talk again at a little bit of a high level here. So we're moving away from the focus on, 2015, 16, 17, where it was just do some keyword research, compete for your BSR and off we go. We're really at a point now where you need to build brand. And when we talk about channel expansion, one of the first things that we look to do inside of South Col, and Nick touched on it a little bit, is that having you in multiple channels and having, at least a 10 to 15% at a minimum channel expansion. So actually having that diversification inside of it. So let's say you have 15% e-commerce and the remainder sat in your Amazon brand. That has a material difference in the potential valuation and the multiple that will be paid, just knowing that the potential acquirers, they're looking to plug you into their ecosystem. So for example, if they had a huge Amazon presence, but had no D2C presence at all, and all of a sudden they're acquiring this business that you have really strong process and systems that you've documented inside of e-commerce, how to build your Shopify store, handle your email campaigns, and all of a sudden, all they have to do is transition all of these products from their Amazon store into this e-commerce absolute smoothly run operation, then they're building real brand, and it has, again, a real material impact on what that looks like. So having that real proper cadence and planning on how you're going to market, the overall business and which channels to really focus on. Branding, again, in the same vein, it's not just about the keywords that you're selling toward, but it's about the brand that you are selling. So having that really continued focus on developing those brand assets and understanding who your market is, and having that brand refresh and having a really clear narrative. We're all suckers for a good story. Nick talked a little bit about South Col, and it's the last base camp before you summit Everest. For us, we take it really seriously too. We want to see people reach their ultimate peak inside of e-commerce, and that's the journey that we're on, and that's the image that we're looking to sell. And you can see here we've cut no corners when we're putting our presentation decks together and how we're approaching it, because every single thing that you're putting out as a brand owner has meaning and touch and feel and tangibility. And if we're sitting here stood behind a $50 million fund and this was a piece of garbage that you were looking at, you'd really question, are we really the people behind the brand that can help me achieve what we're talking about here? So I think for all of you listening, and to take it in board, really assessing and understanding, like, what does my brand look like today? And when I'm trying to take it to a prospective buyer, is it really hitting on that? And this, you guys are probably following on, but this has both growth, multiple expansion, and SDE implications too. Supply chain and logistics, obviously a topical one over the last few years, just given where we were at and the challenges that we had through the peak of COVID to some of the lows that we're seeing now in terms of the cost of shipping. But having it super optimized, consolidation. I know for a lot of the aggregators who are acquiring businesses and had 45 different 3PLs scattered across the country and the globe, these are things that create serious headaches. And if the prospective buyer can't understand where things go, or these things aren't running fluidly, then all of a sudden it creates a really big problem. So being able to come to the table with a really optimized supply chain and having the logistics and the purchasing and everything really where it needs to be has huge implications on that efficiency, on the forecasting, and really understanding the business and making sure that it's run the way it needs to run. And so this really, guys, like at an overview here, so you can see each of the different stages that we really, we stand behind it, but to share with you guys, these are the things that you should really be considering when you're looking to grow your business, especially when we've said it a few times now, but multiples aren't the most attractive that they've been, far from it. We're confident that the market will shift, and it's a moment in time right now. But ultimately, if you're sat there and you're a brand owner, there's a lot of work that you can be doing to actually get yourself right for the time that how we actually approach it. So I don't know if there's any questions there. I can't see anything's written, so I'll just keep running through. But the next little stage here is how we're going to plan. Nick, we can go back and forth here. Here we go. So Nathan said, the data from multiples you showed was for 2022. Do you have any recent 2023 multiples? The short of it is we don't have any figures to that degree of credibility. The more long-winded answer, and Nick's probably better to give more accuracy here, is that it hasn't gone up from the numbers you saw, and it's trended down. But Nick,
it's trended down and volume's down. So generally, in essence, these numbers are going to be about 6 months dated for you to get reliable and actual data, just to be able to compile it, because it is there's not a standardized reporting. It's not like you get this on a daily basis, not a stock market, where we get to see the price and see where it moves. But trailing, you can see, but in general, the earlier and best data that you can look at says volumes are tremendously down again, quarter over quarter. And we're heading into another quarter that the all indications are that it's deteriorated yet again. The real question that everybody always sort of wants to know is, where's the bottom? When does it start going back up? We have not seen where it looks like things are moving upward. I think that what we're seeing now is a little bit of moving sideways, which, if you're an optimist, you would say, hey, maybe that's the beginning of moving up. It's not moving down as much, even though the trends, the volumes are down and the multiples are down. People think that maybe we're starting to see a little bit of sideways movement, and optimists would say that means that hopefully we're seeing the ability to start growing. And I think one of the big things is when we get a little bit more global certainty around how the world looks post-corona. We had a global pandemic that shook up supply chains, shook up countries, families, lives. I mean, the effects were dramatic and real. And we're now working through, I mean, a global economy, it moves slowly. So it's hard to, it's why people make a lot of money and can forecast which way it's going, and how you look at what you look at. But for right now, I would say that generally, I would say that in the 12 to 18 month horizon, I would put myself as a very positive in where the global economy is going to go, where e-commerce is going to go. But I would say that people should focus the next 6 to 12 on making sure that they're running a profitable company and, understand that it's a tough environment.
Nick, could I ask a quick question? The research that you're speaking about, is it kind of done by global wide advisors who I know are part of your group? Or
So GW Partners puts together a ton of information. They have a research department that they're looking at this market. And then there's a lot of stuff that you get from the Fed, the Federal Reserve in the US, you get from economic policymakers. So it's an amalgam of, there's what Wall Street research that the major investment banks do. So you're pulling all sorts of different people who put together research. And what you want are people that fundamentally do that research in a broad and strategic way. And definitely GW Partners has amazing research that we use a lot of and depend on, because they're looking at a lot of it.
that's what I was going to say. The depth, for anyone who's not seen any of their research, global wide advisors is incredible. I've spoken, I can't remember who the head of research was there, but I did speak with someone and interviewed them on
Joe,
on the aggregators actually, and the level of research they did, it was so in depth. So although it doesn't seem very rosy, the research you've painted is probably realistic.
Yeah.
Well, we're here to give the honest, the whole truth, the honest truth, and nothing but the truth. So listen, we are extremely optimistic as to where it will land. Everything is extremely cyclical. If you sort of look at, if you expand time out long enough, things will always sort of level out here. We're just at a tough moment in time, but realistically, we wouldn't be running a business like this if we weren't confident in how it's going to turn out. So chin up, guys, and focus on multiple expansion. Like, focus really heavily on the things that you can actually have control and influence over, because we can't change what people are paying for multiples in the current environment. Or, all you can do is grow big enough for it to make have less of an impact on what that multiple looks like. So diving into the next section here. So we're actually going to share with you like how we as South Col plan like multiple and SDE expansion, and how we sort of look at it at the roadmap. Nick, I don't know if you want to dive in, you want me to go for it?
Well, I mean, I think, I'll jump quickly and you'll finish this. I mean, this is how we look at a company. So after we spend the first 90 days, basically what I would say is our 90-day plan, that's the first quarter, right? 3 months, is we have 20 things, and we look at a company and choose 4 or 5 of them that fit that company. And it might be working with Joe and really cleaning up the financials, or if you already have clean financials, it might be looking at your supply chain, it might be looking at your shipping, it might be, sort of what I call blocking and tackling. But when we get there, as we are spending that first 90 days doing the blocking and tackling that fits most companies that we deal with, we're diving in super specifically to a client. And what we say is we go where you are today. So when you look at this graph, we look at product, brand, and marketing, and we look at your operations and business management. And we go, where are you today? And that's the bubbles that you see at the larger ones here. That's today. 6 months out, what do we want to do in each one of these? What's a goal that we want to accomplish? What do we want to do 12 months out? What do we want to do 18 months out? What do we want to do 24? And one of the things I always point to is, to me, the most important band is that 6 months out. And why do I say that? They're all very important, but that 6 months out, we're going to have year-over-year comps at 18 months. And year-over-year comps are where you really can sell. Hey, we said we were going to, open up the EU. Now look at our EU sales. They're up 20% year over year. We not only launched it, but now we're growing it. You start to see that. And that's what people get very excited about. We launched 3 new products. And here's an example. And Yoni, why don't you walk through this specific? This is a sample company, and you can see here. And Yoni, walk through sort of what each one of these are.
Yeah. So just to ladder onto the back of what Nick was sharing. So in these boxes, and I would say we're probably going to have on our website pretty soon, like this downloadable that you can work through yourself. And we're here to share as much of the IP that we're generating to help fuel all the businesses, but really just marking down the critical things that are going to actually have impact on the business across these 5 key areas that really impact both SDE and multiple expansion here. So you can see here, build roadmap for 15 products inside of products. So starting that one early, knowing that can take time, but has tremendous value at the end. So making sure that when you're actually going through these decisions, you're always working backwards to say, this is what we need our revenue metrics to look like. This is how many products that we need to have. This is where our distribution channels should be. And we don't have it up here, but obviously like what our margin needs to be in order for this to make material sense. And so working backwards from some of the hard numbers, then you're really putting it into working consideration here. One of the things that we like to do, and I think when you're talking about, even though 2 years is a meaningful time in how we're operating, the reality is it takes time to build high functioning teams, and you don't want to lose time, especially we're talking businesses that are not, 10 years old and have 50 employees and have really well-oiled operating structures and, already have like massive distribution. Having said that, we do have some companies that are maybe not that old, but, are 10 plus years old and are operating nicely. But I think for most people, it's, what are the things that are actually going to have that impact? So you can see here, for example, for marketing, select D2C growth agency as an example here. So if you're not selling on Shopify, D2C, and you're on Amazon, in 2 years, it's highly unlikely, unless you have a tremendous amount of experience or you can bring in the right resources and get it done really quickly, you're not going to get to the level you need to be to hit that 15% of total revenue coming from a new channel. So, obviously with South Col, we're injecting quite a bit of money into the business that helps free you up to focus on things that are going to actually expand the multiple. Things like this, obviously, are meaningful. So really just working backward in where you need to be. And I would say also building realistic elements in each of these 6-month timeframes. I'm going to steal Nick's line, one of Nick's many fantastic lines here. But, on the back of the way in which we approach this expansion play, we really have 80 weeks attached to the advisory phase of how we're operating. And if we're not hitting these goals week on week, we're losing literally a couple, nearly 2% each week, 1.5% each week, if we're not making material changes. So I think like, if you're going to put, the beauty and the reason obviously why we give this stuff away for free is the beauty isn't having a nice pretty graph here that tells you what you need to do. It's actually executing on it and holding yourself accountable. And so this is how we get there. This is how we get started. But I think the real work comes from how you execute on all of these things and you get to a serious place. So
and one thing, Yanni, but you always, is like each one of these things, what they are, they're boulders, and there's a million tasks or 150 tasks that lead up to each one. And so one of the things that we sort of really focus on is, while there might only be 8 things in the 12-month ring, those 8 things absolutely have 20 things behind each one. And the real way to succeed is by getting down to that specificity and tracking and going, we needed the EU label, this week. If we don't have it, it messes everything up. And then identifying what you can do in parallel versus in sequence. And anything that's in sequence, you better make sure you're hitting it, because in sequence, by definition, it means any one gets held up, everything down the line gets pushed back. And that's why when we have meetings, we have our chief operating officer, she's on there and she's going, this is what needed to happen. And if it didn't, we need to know why and how to get it done. Because it isn't about anything other than, if this is a 2-year sprint, and that's a long sprint. So you got to break it down. You got to break it down to weekly things, but it keeps coming.
Amen. So as we sort of work backwards to hit our objectives, and what the acceleration roadmap looks like, we're doing things like having a real deep dive into that growth plan. So, how we approach it, remembering like the whole point of this, share how we approach it and how you can take these things and implement them at home yourself. We're taking a serious SWOT matrix analysis and a maturity analysis, a framework that we designed inside of Escala, deploying into about 120 or so companies to date, from sort of $1 million to 250 million in revenue. We understand, where the business is and where it needs to be. And so we're always sort of trying to understand how optimized can we get this business from where it sits today to where it needs to be, so that a prospective buyer sees that there's tremendous value in it. And, with that SWOT matrix analysis, really understanding like where are the strengths and weaknesses that we need to attack that align with that roadmap that make a whole lot of sense, and what opportunities exist so that we can actually drive forward. A lot of the things that we're also approaching here is that growth implementation roadmap. So how are we actually aligning the company, whether it's 5 people or 50 people in the company, how are we actually aligning that growth roadmap to the business KPIs and the goals that we've set here against each of the different accountable managers inside of that business? Or if it's 5 people, like what are the things that they need to achieve that ladder up into our business objective over those 6-month incremental periods? Having it really dialed in a project management tool and having those workflows and integrations. How we like to operate and the things that we're doing inside of South Col businesses is we'll build the entire workflow into ClickUp or another project management tool. Every single stage of every actionable item inside of the business is built into this wiki, and the workflows are connected. So I will know within, the litmus test for us is, if in 15 seconds, I'm not sure how to do something in the business, even if I've never stepped inside of that function before, then we failed here. So these are the things that we're doing to make sure that founders are actually getting out of their own way and focusing on the things that really have tremendous value when we talk about exit. Partner services integration. So making sure that we have the right resources in play to free up the founder and make sure that the reality is here, they're not doing the things just because they can do them, but they're being, given hand-picked resources that have already stood the test of time and are pre-vetted. Making sure, talked a little bit about accountability and that accountability and growth roadmap and the KPIs, like having that accountability chart and actually auditing, do I have the right people? Because, getting from 0 to 1 million is one thing, and 1 to 5 is slightly different, but 5 to 15 million is a totally different ball game here. And if you don't have the right people in the right seats who are actually operating in the right way and can get you to those levels, then they become inhibitors. So making sure that we're really assessing, do we have the right people to get us there? The finance and accounting transformation roadmap. So how do we take it from what might be a few Excel sheets and, peeking into a Shopify or Amazon account? And I'm sure Joe can probably speak to this far better than I can, but ultimately, going to guys like Joe and actually having him do the heavy lifting, with the partner network and the resources that we bring in to make sure that you're actually in a great position for when you're looking to be sold, because there's nothing worse than coming to that deal day getting excited about the multiple and having the wrong numbers actually input because you're negotiating against one thing. And it turns out that, you know what, the margins weren't exactly what they were, but you were very happy at that multiple if it was at that size. But if you get those things wrong, you lose a lot of leverage. So another thing, the product development roadmap. So for us, it's really how do we turn it from, let's say, 5 products launched a year to 15 or 50, depending on what category we're in, and really understanding what is the upside potential of the brand and the key people inside of it. And then building out those future state operational designs. So I talked a lot about all of these things, from the accountability and org charts to the process maps and that company wiki. So this is just, guys, I'm just going to sort of gloss through these things. I mean, anyone can stop me at any point here, but I'm just literally showing you some of the sample insights and docs and the things that how we're operating and what we're doing here. You know, obviously it's anonymized, and, you know, we've taken things from different areas to make it somewhat confusing here. You know, we would hate someone to see their buddy's business here and say, I figured it out. But ultimately, you know, when we're talking about a SWOT matrix analysis, we're looking at what are our objectives? What are we working toward? And what are the strengths, weaknesses, opportunities, and threats that exist inside of the business in terms of hitting that achievement? I talked a little bit about the maturity assessment that we do. So for us, really understanding based on the different core functions inside of the business, how optimized are each of them based on people, process, and technology. How we look at the world from an operational standpoint is it's the perfect harmony between those 3 pieces that makes a system. And so how do we bring that maturity score from, you know, an average of 1 point or 2.3 or whatever it works out to be here to a 4 across the board, where a 4 really means that in our methodology that we really no longer have any key woman or man risk inside of the business. Things are running. It's not 100% optimized. And I would also caution, probably isn't the right word here, but I would recommend that if you take things too far and there's no upside opportunity that a prospective buyer can see, and you've really you've taken it to the nth degree here, you know, they want to see that they can make some quick changes to start to make back the money and the investment that they've made into buying the brand. So taking it to a point where it's in the best shape that it can be, but there's still room for them to grow. For us, when we talk about that growth and implementation, we're really looking at, you know, what are the things that we can implement, and how, you know, this sort of bleeds into that roadmap. So once we've assessed the business, we can really start to look at how hard is it to implement, what's the time duration and complexity and the feasibility and the actual impact of business. So this is just another visual way in starting to look at how we sort of build out that roadmap, but this is more so getting to that next stage. You know, we have here like the areas for improvement and the recommendations, and actually starting to list, like, it gets way more detailed is, I guess, the main point in everything that I'm sharing with you here is that the roadmap helps set the tone based on the information that we've brought in. But a lot of this stuff is where we start to actually get to work. You know, this is an example of how we start to build out the KPIs against the company goal. And again, you know, all this stuff becomes pretty helpful for you when you're trying to do it at home yourself, to really understand, like, how do I actually get there? What do I need to achieve, and who needs to achieve it? I talked about project management tools. We are huge fans of ClickUp. It's really revolutionized, also very affordably for a lot of businesses, the way in which they operate. And then coming into it, you know, we're defining the future state org chart. So what does the transition look like over the course of that next 2-year period? Do you need to bring people in? Is it external resources? How does that actually look? And then having, again, these are just samples of SOPs that we've done through a Scala of the high level process maps and then the sub processes. So each one of these boxes has its own sub processes that look like this, where now you start to understand that this is the overview of the business. This is what's happening at a very high level. And now this is what each individual is doing at each level, that then gets built into ClickUp workflows and tasks with the company wiki attached. And then it looks more like, you know, SOPs is how people would define what we would define as our level 4 and 5, the last bottom stages, and really that's, you know, there's so much, it's so dense, there's so much to talk about here, but the idea really, guys, was just to share a little bit of the things that we felt would be helpful when you're really trying to attack, you know, the remainder of 2023. We're almost halfway through the year now, and you know, things are definitely, it feels like in some facets, trending in a slightly better direction than, you know, what was a very bleak, the outlook at the end of last year, and, you know, I would even say into January this year. So very happy to answer any questions that you guys have with the time that we have left here.
Yeah, so I see Nathan read my mind. I was about to ask this one. So he's asked, how is a partnership with you structured? And I think if you could kind of elaborate, because we never really said at the beginning, we just jumped straight into it. Like, what's in it for you guys, right? So you've got this fund of money. You're looking for brands to work with. You've got, like, if someone sat here and seen, oh, Yoni's had enough. He's if someone sat here and they've kind of
hit by the
like,
sun.
They're like, these guys are great. They've got loads of money. They've got loads of processes. Like, they're going to clearly help me exit. How does that work practically, and what do you guys get from it?
So the way we structure a deal is we're going to come in with some amount of capital. Let's just sort of, you know, think about it a little bit higher level, right? We'll come in with $1 million of capital to use to grow. In return for that capital, we're going to set a valuation for your company today and say that that's what it's worth. And then we're going to participate at some percentage of the growth from that. So if your company today, you know, we'll take your, you know, trailing SDE, multiply it by 4, and say, okay, that's your company today. Even though the market, you know, we saw it might not even be there right now. That's what we'll say is the threshold for us to be able to start participating. And then when it gets above that, then we start participating in the returns. So what you see there is we have unbelievable alignment, because if we don't create value, we're not getting anything. But when we create value, we're participating with that entrepreneur. And so that's our incentive. And that's why we say we work alongside you, because all we want to do is see that multiple go from 4 to 8. We want to see that SDE go from 1 million to 2 or 3 million, because then we're all participating and sharing in that, if that answers the general structure. And then in general, we're going to take 20 to 30% of that upside with our initial investment. That's, you know, and it's going to depend on the size, the growth potential, and where you are. Like, I do say to people that every entrepreneur should believe in their heart of hearts that they can double or triple their business, because that's what an entrepreneur, that's the mindset of an entrepreneur, and that's good. When we come in, what we tell entrepreneurs is that means we believe that we can triple the business, that we share your vision, that we're drinking the same Kool-Aid, and we see how to do it, and we want to be a very helpful part of it. Because one of the things that we do, we didn't hit on a ton, but we have weekly meetings from our operations team to the client's operations team, and that's who's handling sort of the tactical. And we have a weekly call with one of the founders who sits on the board of the company with the entrepreneur, and that's a top-to-top meeting where we're talking strategy. But obviously, we also make sure that everything is going. And that level of high touch, where we're talking about at 2 levels of the organization, at least weekly, when we're meeting, that's the level of side by side we are with entrepreneurs that we exist.
And what's the sort of, I suppose, like, ideal client or business for you guys to work with? Because you've kind of mentioned that certain lower revenue thresholds, it's kind of not practical. What's the ideal sweet spot for you guys?
For us, we, you know, I think it's, you know, 4 million to 25 million in sales with, you know, 15 to 25% net margin.
And that's USD, right?
USD, yeah. So we
So,
we'll do pounds. For pounds, you just take down 20%. So we'll come down to, you know, 3.4 million pounds to 20 million pounds.
And Yoni, a few people have separately asked me about the slides. Will I be able to share that with people afterwards?
I will confirm with you. There's a few things that we need to change. Like everyone's literally rebranded out of the 3 companies. We're about to roll out ours. We're not making an announcement about it. I would say yes. We're probably going to release this is behind closed doors. So I'd say if yes, keep it to yourselves, because we are going to come. We've brought on, just for context, Adam Runquest as an advisor to South Col. If you guys know who he is, he's a notable face in the space, and will likely give this presentation to his sort of 20,000-30,000 YouTube subscriber base. So we want it to feel fresh, and it's never been shared in a public forum. So just giving you context.
Cool. Well, I won't email blast it out then, but there's 2 people that have mentioned it to me. So
let me update those logos and I'll get it to you, and you can send it to those that are on the call for sure.
Cool. Thanks for that. I did have another question, which is pulled away from me now. Has anybody else that's still here in the Q&A got any questions? Oh, there we go. Amanda.
Can we open it up? Can they get on the screen as well, or you can't do that here? Is that too risky? Someone's going to get on and start yelling at me.
Amanda said, what would be the best approach to grow a 6-figure Amazon business based in the UK? She's a little early in this journey, but the presentation was really useful to start strategizing.
Well, I would say, and Yoni, help me out with this, but I would start with, first of all, that's amazing. That's a great start. And the way to do it is you have to understand your product market fit. So the first thing I would say is your most successful product. If you're selling that much, you obviously have a SKU that's selling. I would really look and say, who are we speaking to? Who's your product speaking to? What dilemma is it solving, or how is it creating happiness for the end user? And are there more? Can you broaden? So there's 2 ways to grow. One, broaden the use. So if it's something that is addressable to one market, could you expand that market? Because if you get more people who want to buy it, you can sell more. Then the second thing is, can you create products around it? So for example, easy one, like Omaha Steaks sold steaks. They'd send you steaks to the thing. They actually grew when they added potatoes and broccoli and sides, because all of a sudden, instead of just buying the steaks, people were buying their full dinners. So that would be an example of adding products alongside the main product that you can then sell, because that gets your average order value to go up. Then the other one that I would look at is, can you go up or down market? And so if you're selling something that is, let's just say at $15, are there things that you can add to the product and make it so you can sell at $25, because maybe you're addressing more needs? An example there would be like therapeutic massage guns, right? You'll see that they have, a $300 version, a $200 version, and maybe an entry model. And then if there's any possibility, when you build out an Amazon business, one of the things that I would, say you want to really think about is, really, could you sell as D2C? Because there's some real advantages to being D2C as well. So could you go direct to the consumer and sell off of the platform? Now, there you're going to have increased costs of marketing, but you're going to have less cost. You're not paying Amazon, right, to be in there. So those are some building blocks. We're happy to sort of talk to you specifically more if you want, or give you some sort of things that we're thinking about. We love working with e-commerce folks, and we have a lot of people that we talk to who we hope one day are going to get to that threshold of where we could get involved, and hopefully that's it. Yanni, anything I left out?
Yeah, I would say, again, to your early point, congratulations. Where we look at it from the lens of, Nick explained the model. For us, we're spending 2 years in a business, and it just needs to be at it needs to be at a material size for us to invest, countless hours into the business with the prospect of the upside of where it sits. And so that's the only reason why we're not working with smaller brands. As we build a scalable model into this, who knows what the possibilities are, but just firstly, congratulations. I would just say, some of the less tactical, and it's been a minute, just I didn't come up in the conversation, but I was able to grow an Amazon brand from 2 to 5 million in 12 months that was acquired by Thrasio, and, had, cut my teeth after having 10 years in creative advertising, digital marketing in the Amazon ecosystem. And what I would say, and some of the things that I learned when I was selling physical product, and I would say in business in general, is just to have a high degree of focus. I think that all the stuff we're talking about can seem really sexy. Yeah. Global expansion, 15, 20 products, starting to think about IP and patent law, you should definitely be focused on. Let's not take that one off the table, but it's all got to be done at the right time. Like, if you don't have the cash flow or the means to get your hands on the right growth capital, then all these exciting plans all fall down, because you're just going to blow up your business. So I would just say, slow and steady wins the race, and getting the clarity that Nick shared on what are the SKUs that are performing, what is the data and information that I can extract from my business to actually make good decisions on how it looks. One of the things that I tend to ask people the question, if you have, let's say you have 30 SKUs, typically what will happen for a lot of sellers is that they'll have 1 to 3 hero SKUs, and the rest won't be performing at the same level. And it's often not because they're bad products, but actually they just don't get the same love and attention. You get really excited about the product that's performing really well. So finding a way to build a degree of consistency and a scalable process in how you give the same love and attention around PPC management and design and A/B testing, and that understanding across all of your products, and then making good decisions on what needs to stay and what actually is a hero product that builds into your brand and that brand expansion, as opposed to having a whole lot of just dotted products that aren't actually connected, that also isn't an attractive exit target. And just always working backwards from where you want to be. That would be my 2 cents on that matter.
Cheers,
Jumping in, Nathan asked some very good questions, so I'll try to jump into those. They're great questions, and so he said, where does South Col create value, strategy, process, operations, hiring? What makes you the best to add value to a company through the partnership? That's a great question, and I'll try to answer it. I think the answer is, it's what the company needs. When we look at a portfolio company, there are companies we're always going to have value. We're always going to be able to, we dig in, we ask difficult questions. We make sure that when decisions are made, that they're made through a process by which it's defensible, where it doesn't mean we're going to be right every time. Nobody is. So what we try to do is we at least can say we followed a very prescriptive process that usually leads to the best outcomes. In terms of process and operations, we're going to make your company be able to survive a sale. And what I mean by that is, when you have the process and operations mapped out as in detail as we always do, that is to an acquirer super valuable, because they realize that when you leave the business, because you, the entrepreneur, are the most valuable part of that business. And when you leave that business, what you leave behind, those operation SOPs and those process maps, are what the acquirer goes, I can do this. I see where everything is. There's none of this, I just know what I do in my head and I do it, because a lot of entrepreneurs, that's what they do. And that's awesome. There's nothing wrong with that. But we really sort of try to move it out of your head and put it down onto paper, because that's saleable. That's something that we can create multiple expansion. And then in terms of the ongoing, we're going to sort of have a lot of time spent on strategy, process, operations, and then if you need hiring, that's going to be very specific to your needs. Where we just, for one portfolio company, hired in a logistics manager, a operations team member, and a revenue
supply chain.
guy. So yeah, and so when the need is there, we're going to hire into that need. But obviously, we only hire if there's a need. So that's not every client that needs to do it. Then you went on to ask Nathan about influencer marketing. And
right, before you dive into that, I just want to be very blunt here as well, Nathan. You asked what makes us the best at doing this. I would say, firstly, we're the only company that exists. We're the first to market in coming up with a solution where we're injecting capital in this space growing the company for this period of time. And like Nick has really clearly explained, building a model that is like fundamentally win-win for the seller who's looking for the largest possible exit, and us, where we're aligned with, if we don't perform, we see nothing. And that, to us, just, that's also why we're quite selective, to be blunt as well. Like, there's hurdles that need to be jumped over in order to get, into this circle of trust here. But what makes us the best, Nick touched on it, sellers FI, where the capital comes from, they're one of the premier capital lenders in the space, well over 300 million in loans out right now. And that number just continues to grow in a market where it's very hard to get access to capital and to lend capital. So they're clearly doing something right there. You have global wired advisors, or GW partners now, who have north of $1 billion in transaction value and would be the premier investment bank in the entire Amazon and D2C ecosystem. They're typically only touching businesses that will sell for a minimum of $10 million. That's the starting point for when they would have open dialogue. I mean, sure, Chris is the nicest guy and he'll speak to you and he'll help you out.
You're just saying that because he's in the audience now, aren't you?
There he is. But ultimately,
well said, John. That's exactly right.
Yeah, I actually didn't say g'day, Chris. But ultimately, yeah. So he would speak to you, but ultimately they're not. That's what they're doing. They're looking at big brands and they're looking to maximize their outcome. And us as a Scala, we've spent 2.5. We have 35 full-time management consultants. The majority of them come from Ernst & Young. Some are from Accenture and Deloitte, and have worked on enormous businesses. We built our own methodology focused on e-commerce businesses purely, have been deployed into more than 120 e-commerce businesses, ranging from about $1 million on the small side in annualized revenue to 250 million. Worked with a ton of the aggregators, and sort of coming together and bringing this model together. We sort of brought together all the pieces of the puzzle that a lot of the aggregators struggled with, expanding too quickly, trying to bring in a huge amount of capital that was disproportionate, and trying to find ways to invest it into things that might not have been mandatory at that exact time. Not removing the founder and actually investing in them and having them take these steps and going through it. We spent a lot of time on those integration plays. We'd be deployed into businesses, building out the processes and helping them actually integrate into to aggregators as well. So we've seen a lot of businesses at a lot of different sizes. Global Wired or GW partners have the answers to the cheat sheet, and in a market where it's really hard to get your hands on capital, we're able to inject $1 million to $5 million into businesses and create this win-win. So I would say, Nathan, that's the reason why we'd be the best to do it. And if as we start to exit these companies, we're being candid here, we're relatively newly formed. We're under 12 months old as a business. So the first exits that you'll see that are on the back of South Col will only happen into early next year. We've seen well over 100% growth in the businesses we've invested in to date. And we're looking at, we're really looking, when we talk about that selective nature, we're not looking to just sort of, step in and take it from $1 million in EBITDA to $1.5 million, or a $5 million revenue business to 7.5 or even 10. We're really looking to hit this right out of the park. And it's to that discretion as well, especially being earlier stage, that we're committed to making and picking the right partners and really driving this forward. So it's a really long-winded answer for you, but obviously I'm passionate about it. We've spent a long time getting to this point, and have the utmost confidence in the team and what we're looking to build here, and most importantly, the founders that we're looking to support.
And I'd also say it doesn't matter if you are the best. It's about doing the job properly and getting the right results. Yeah, but I don't see if you.
Yoni's not going to let this one go. We have to just accept that we're the best.
Yeah.
Otherwise, Yoni's not going to stop. We got to agree with that. But
You know, if in the famous words of Ricky Bobby, if I'm not first, I'm last. So you know, that's that. But that's the mindset. Like, you know, to all jokes aside here, like, we're sitting with founders and high level execs in some of the larger businesses that we're working with on a weekly basis. One of us from the founding 5 of the core team are sitting with them for 30 minutes a week. 2 management consultants are sat with you every week, making sure that you have all of the necessary resources. Like, it's a really heavy investment from our side without a guaranteed promise of upside, only if we perform and the founder is the right fit to actually, you know, continue to make all the good decisions. They're the majority owner and decision maker of this business. And the ultimate reality here is that we need the right people to get into bed with and make sure that we're sort of aligned with the desired outcome.
Yep. And then just quickly, Nathan asked another great question is, influencer marketing has been a big part of success. And is that seen as a positive or negative to an acquirer since it adds a layer of complexity? Would they think that it's difficult for them to replicate since we've developed relationships with influencers and sales can vary depending on how many shout outs we get? So number one, I would say I would address this from a process standpoint. So we would document, how did you build the influencer that you have? Because that's the part that could be replicated, that someone who buys it could take how you develop those relationships. But yes, if that's a part of your brand that you're having somebody call out how you do it, we would say, how did you accomplish it? And how can we do it again? And can we replicate it? If it's completely unreplicable, that is going to be both, I think would be, I've never seen, most things are, even if they're not at first blush, seemingly jump off the page, when you really dig into them, you can start saying, okay, you go to, if you're a beauty product, you go to BeautyCon and you meet the people that are influencing there, you become friendly with them, and then you do this, then you have them try your products, and you know, they do an Instagram live where they're putting on your makeup, and you know, people are loving how they look. It looks great. Like, you actually can foment that and create that. And we would really dive into how you would do it, because we have yet to see something that we haven't been able to document and say parts of it, even if it's built from relationships that you have as the founder, that's not replicable. But a lot of the process might be, and we would look for those parts, because that's what we'd be selling to a person. Because a buyer doesn't want to buy something if they feel the whole thing walks out the door when you leave. Is the best I can sort of answer that. The short answer, but there's more to it.
And Nick, one other thing, I know we're kind of really close for time now, but Nathan asked the question about, do you recommend expanding to the EU, even if you're successful in the US, and potentially leaving something on the bone? I know you answered it, but so you said you would look to expand rather than leaving meat on the bone. Why is that?
Okay, that's a great, so to delve into that even further, it's a great question. The reason why is that one's actually executable. So the things that we try to leave on the bone are the really difficult things. So for example, if we're looking at something that will do well in retail, because again, we're talking all e-commerce right now, but let's not lose sight of the fact that people still go to stores, and having a presence at stores is valuable. And so we don't come with a myopic that like, we don't want to be in stores. But when you want to go on 2,000 shelves at Target and try to be at the end cap, it's an incredibly high level of investment. So what we look at is how about we do a 20-store tester, show that you can sell at Target, but that I'd leave to an acquirer. Let some huge CPG buy you, who can put them on all the shelves and have it stocked, have it right, the right level, the right eye level, the right position, right part of the store, care for all of that. That's very difficult to do. That's something that as an entrepreneur, you can't do what that huge company does. So let's leave that, but we put that on the process roadmap. And what we do is show that you test well. So that shows, hey, high sell-through rate, you're doing well, and acquirer goes, perfect. We know we can put this product on the shelves. EU, it's actually quite doable. Now, it isn't easy. So I don't want to just sort of it isn't, but it's actually very executable. It's like, we know that we put most of our clients, if they're in the US, we're going to put them in UK, EU, because that to me is like, a foul line jump, if we're going to be sports driven here, like we can hit that. Let's do that. We'll leave the 3-pointers, for the acquirer. And like, let's take some of these ones that are a little bit more than a layup, but are valuable. And because when you grow that EBITDA, because remember, because like I said, because you can do this, you want that EBITDA. If it's at $1.5 million, hey man, let's get it to 2.5, because whatever multiple you're paying, now it's off a bigger number. That means more money for you. And so we wouldn't want to leave that, on the table and you not get the value for it.
But doesn't it look more like, I suppose the point that Nathan's trying to get at is, if the acquirer sees it and thinks, oh, like this is more attractive because there's lower hanging fruit, right? Do they think like that, or do they just say, oh, it's too small?
I would say,
yeah,
I would say just on that one, like, Nathan, you're talking about, you're at 1.5 million in EBITDA, like you're starting to get into some pretty meaningful numbers here. And I would say, like, it would be counterintuitive to not look to expand to hitting those 2.5, 3, because once we start talking about private equity and strategic buyers, they have a totally different infrastructure and they have a high degree of focus in what they're looking to do. So to take Nick's example here, if you're not in brick and mortar, you could be, let's say you're a CPG brand and you have something that is an absolutely perfect fit for a strategic buyer who knows that they have all of the contacts into retail, brick and mortar globally, but they don't have the e-commerce piece, but maybe they have the e-commerce piece and it fits perfectly and they can cross-sell it into their portfolio, then that's just another way in which they can add value. So when we start to talk, like, I would just say, like, as you're pushing up to more meaningful levels, like the equation also changes, because what they're able to do and what they're capable of doing is, it's just much more significant.
Yeah, and the other, Joe, that I would say, Nathan, that this gets into, and this would require a much deeper detail. What I try to say to entrepreneurs is, go whatever level you're at. So like $1.5 million EBITDA. What we need to do is come up with projects that move that needle 500,000 of EBITDA. So what can you do that can create 500,000 of EBITDA? So that's the question that I would sort of sit down and go, is it a new product in the US? Is that going to have a higher chance of success of creating huge amounts, 10 to 20% more EBITDA, right? Because the way we try to break down doubling is saying you need 4 or 5 things that produce 20 to 25% of growth. Okay. And some of that might be growing an existing SKU. So when we do that, we go, is this one of those 5? And if the EU, if we look at it and go, okay, you're selling, 10 million in the US, well, you know what? We believe year 1, we could do 3-4 million in the EU. Well, let's do it, right? Because that's going to produce that. So it would be sort of this, like, we would have to sit down and go, is it one of the top 4 ideas to produce? And if it is, then you should be doing it. If it isn't, then you leave it for the acquiring. I think that's sort of more detailed of like how we would look at it.
Nice. Well, guys, I'm very conscious of time and we've run slightly over. If anybody wants to get in touch with you, should they visit South Col? Should they message me to introduce you?
Anyway, I'm Nick at South Col, and he's Yoni at South Col.
.co.
Yeah. And our website, you can go on there and you can submit a form and it comes right to us and we'll respond that way. And obviously you're free to give anybody our information. We would love to have detailed conversation with anybody who is interested. We enjoy the conversation. We enjoy knowing people in the space, and you can't go anywhere without seeing Yoni speaking at pretty much every event that happens globally. So
I'll actually be at Seller Sessions Live. I'm not speaking, which is nice, but I'll be at Seller Sessions Live. So for anyone who's in London this weekend, come get it.
And thank you everybody for your time, and thank you for having us on. Really appreciate it, and appreciate working with you and your clients.
Likewise, thanks. It's been enjoyable. Thanks a lot, everyone, and I will send this out in an email. But thanks for joining us, and for those of you that have stayed till the end.
Thanks a lot. Thanks, guys.
Thank
Thanks, Joe. Great stuff.
Oh, you're the host, Yoni. I can't stop the recording.
I'll end the webinar for all.
All right then. Cheers, mate.